Good day. Today we continue with the market structure. One of the most important skill that all you need as a trader is the ability to read the market structure. It is a critical skill that will allow you to use the right price action strategies in the right market condition. You are not going to trade all the markets in the same way. You need to study how the market moves and how traders behave in the market. The market structure is the study of the market behavior. And if you can master this skill, when you open your chart, you will be able to answer these important questions. What the crowds are doing, who is in control of the market, buyers or sellers, what is the right time and place to enter or to exit the market, and when you need to stay away. Through your price action analysis, you will experience three types of markets: trending markets, ranging markets, and choppy markets. In this chapter, you will learn how to identify every market and how to trade it. We start with number 1, trending markets. Trending markets are simply characterized by a repeating pattern of higher highs and higher low in an uptrending market and lower high and lower low in a downtrending market. See example below. As you can see in the example above, the market is making series of higher highs and lower lows, which indicates that the market is uptrending. You don't need indicators to decide if it's bullish or bearish. Just a visual observation of price action is quite enough to get an idea about the market trend. Look at another example of the downtrend market. The example above shows a bearish market. As you can see, there are series of higher lows and lower low, which indicates an obvious downtrend. Trending markets are easy to identify. Don't try to complicate your analysis. Use your brain and see what the market is doing. If it's doing series of higher highs and lower lows, it's simply an uptrend market. Conversely, if it's making series of lower highs and lower lows, it's obviously a downtrend market. According to statistics, trends are estimated to occur 30% of the time. So, while they are in motion, you've got to know how to take advantage of them. To determine whether a market is trending or not, you have to use bigger time frames such as H4, the daily or the weekly time frame. Never try to use smaller time frame to determine the market structure. How to trade trending markets. If you can identify a trending market, it will be easy for you to trade it. If it is a bullish market, you will look for a buying opportunity because you have to trade with the trend. If the market is bearish, you have to look for a selling opportunity. But the question is, what is the right time to enter a trending market? Trending markets are characterized by two important moves. The first move is called the impulsive move, and the second one is called the retracement move. See the example below to understand what I'm talking about. Can you see the impulsive? And then can you see the retracement? As you can see, the market is making higher highs and higher lows, which indicates a bullish market. If you see this market, you will think of buying, but as you can see, the market is making two different moves. The first move is impulsive move, and the second one is a pullback or a retracement move. Professional traders understand how trending markets move. They always buy at the beginning of an impulsive move and take profit at the end of it. This is the reason why the market makes an impulsive move in the direction of the trend,
and retraces before it makes another impulsive move. If you are aware of how trending markets move, you will know that the best place to buy is at the beginning of an impulsive move. Traders who buy an uptrend market at the beginning of a retracement move, they got caught up by professional traders and they don't understand why the market hints their stop loss before moving in the predicted direction. See another example of bearish trend. The illustration above shows a downtrend market. As you can see, the best trading decision is to sell the market at the beginning of an impulsive move. If you try to sell in the retracement move, you will be trapped by professional traders and you will lose your trade. Now we know how to identify downtrends and uptrends and how to differentiate between an impulsive move and a retracement move. This is very important for you as a price action trader to know. But the most important question is how to identify beginning of the impulsive move to enter the market in the right time with the professional traders and avoid being trapped by retracement move. To predict the beginning of impulsive move in a trending market, you have to master drawing support and resistance level. So, what are support and resistance levels and how to draw them on our charts? This is what we'll illustrate in the next chapter. Support and resistance levels. Support and resistance are proven areas where buyers and sellers find some of equilibrium. They are major turning points in the market. Support and resistance level are formed when price reverses and change direction, and price will often respect these support and resistance levels. In other words, they tend to contain price movement until, of course, price breaks through them. In trending markets, support and resistance are formed from swing points. In an uptrend, the previous swing point acts as a support level, and in a downtrend, the old swing point acts as a resistance level, as you can see below. The illustration above shows how the previous swing point acts as a support level after the breakout. When the market makes the retracement move, it respects the previous swing point, that is the support level, which will represent the beginning of another impulsive move. As you can see, when the market tests the previous swing point, that is the support level, it goes up again. By drawing a support level in an uptrend market, we can predict when the next impulsive move will take place. Let's see another example of a downtrend market. Can you see this? The illustration above shows us how the market respects resistance level. When price approaches the previous swing point, the illustration above shows us how the market respects resistance level when price approaches the previous swing point. The market makes an impulsive move. If you understand how price action acts in a trending market, you predict with high accuracy when the next impulsive move will begin. Another way to catch the beginning of an impulsive move is by drawing trend lines. This is another technical skills that you have to learn if you want to identify key linear support and resistance level. Let me explain first what the trend lines mean. Quite often, when the market is on the move, making new swings, highs and lows, price will tend to respect a linear level which is identified as a trend line. Bullish market will tend to create a linear support level, and bearish markets will form a linear resistance level. How to draw trend lines? To draw a quality trend line, you will need to find at least two minimum swing points and simply connect them with each other. The levels must be linear. Don't try to force a trend line. Don't use smaller time frame to draw a trend lines. Use always the H4 and the daily time frame to find the obvious trend lines. We will try to focus right now on how to draw them in a trending market. Our purpose is to identify the beginning of impulsive moves in a trending market. In the next chapter, I will explain to you in detail how to trade trend lines in combination with our price action trading setups. See the example? As you can see, the market respects the trend lines, and when price approach it, the market reverses and continue in the same direction. When the market makes moves in this way, trading lines help us to anticipate the next impulsive move with the direction of the market. Look at the example of an uptrend market. As you can see, the market makes respect. As you can see, the market respects trend line. And by drawing it the right way, we can easily predict next movement upward. This is all what we can say about trading markets. I think it's clear and simple. Now what I want you to do is to open your chart and try to find trend line markets. Find previous swing points, that is the support and resistance, and try to find the trend lines as well. This exercise will help you to understand how trending markets move and how to predict high probability entries in the market. Ranging market. Ranging markets are pretty straightforward. They are often called sideways markets because their natural nature makes them appear to drift to the right horizontally. When the market makes a series of higher highs and lower lows, we can say that the market is trending up. But when it starts making these consecutive peaks, we say that the market is ranging. A ranging market moves in a horizontal form, where buyers and sellers just keep knocking price back and forth between the support and resistance level. As you can see in the example, the chart above shows a ranging market. The price is bouncing between horizontal support and resistance level. The difference between trending markets and ranging markets is that the trending markets tend to move by forming a pattern of higher highs and higher lows in case of an uptrend, and higher lows and lower lows in case of a downtrend. But ranging markets tend to move horizontally between key support and resistance level. Your understand of the difference between the both markets will help you better use the right price action strategies in the right market conditions. Trading ranging markets is completely different from trading trending markets because when the market is ranging, it creates equilibrium. Buyers are equal to sellers and there is no one in control. This will generally continue until the ranging structures broke out and the trending condition starts to organize. The best buying and selling opportunities occur at key support and resistance levels. There are three ways to trade ranging markets. I am not going to go into details because what I want you to get here is the skill to look at your chart and decide whether the market is trending or ranging. In the next chapter, we go into details and I will give the trading tactics and strategies that you will use to trade trending or ranging markets. If you can't differentiate between ranging markets and trending markets, you will not know how to use these price action strategies. The first way to trade ranging market is by waiting for price to approach support or resistance level. Then you can buy at key support level or sell at key resistance level. As you can see below, the market is moving horizontally. In this case, the best buying opportunity occur at the support level. The second way of trading ranging markets is by waiting for the breakout from either the support level or resistance level. When the market is ranging, no one knows what's going to happen. We don't know who is going to be in control of the market. This is why you have to pay attention to the boundaries. But when one of the players decide to take control of the market, we will see a breakout of support or the resistance level. The breakout means that the ranging period is over and the beginning of a new trend will take place. See example below. As you can see, the market was trading between support and resistance levels, and suddenly the price broke out of the resistance level. This indicates that the beginning of a trend is likely to happen. So, the best way to enter is after the breakout. It's important to remember that range boundaries are often overshot, giving the illusion a breakout is occurring. This can be very deceptive, and it does trap a lot of traders who position into the breakout. The third way to trade ranging market is to wait for a pullback after the breakout of the support or resistance level. The pullback is another chance to join the trend for traders who didn't enter in the breakout. See example below. As you can see, in the chart above, the market was ranging. Price breaks out of the resistance level to indicate the end of the ranging period, the beginning of a new trend. After the breakout, the market comes back to retest the resistance level that becomes support before it goes up. The pullback is your second chance to join the buyers if you miss the breakout. But pullbacks don't always occur after every breakout. When it occurs, it represents a great opportunity with a good risk to reward ratio. What you have to remember is that a ranging market moves horizontally between the support and resistance level. These are the key levels that you have to focus on. The breakout of the support or resistance level indicates that the ranging period is over. So you have to make sure that the breakout is rare to join the new trend safely. If you miss the breakout, wait for the pullback. When it occurs, don't hesitate to enter the market. When you are trading ranging markets, always make sure that the market is worth trading. If you feel like you can't identify the boundaries, that is the support and the resistance, this is a clear indication of a choppy market. In Forex, choppy markets are those which have no clear directions. When you open your chart and you find a lot of noise, you can't even decide if the market is ranging or trending. You have to know that you are watching a choppy market. This type of market can make you feel very emotional and doubt your trading strategies as it starts to drop in performance. The best way to determine if a market is choppy is just by zooming out of the daily chart and taking in the bigger picture. After some training, screen time, and experience, you will easily be able to identify if a market is ranging or is a choppy market. Here is a good example of choppy chart that's not worth trading. Notice in the chart above, the price action in the highlighted area is very choppy. and is moving sideways in a very small tight range, this is a sign of a choppy market that you should stay away from. If a market is choppy, in my opinion, it's not worth trading. If you try to trade it, you will give back your profit shortly after big winners because markets often consolidate after making big moves. Time frames and top down analysis. As a price action trader, your primary time frame is the H1, the H4, and the daily. Price action works on bigger time frames. If you try to trade pin bar or engulfing bar on the 5 minutes time frame, you will lose your money because there's a lot of noise on smaller time frames and the market will generate a lot of false signals because of the hard battle between the bears and bulls. Besides, there is no successful price action trader who focuses on one time frame to analyze his charts. Maybe you have heard of the term top and down analysis, which means to begin with bigger time frame to get the big picture and then you switch to the smaller one to decide whether to buy or to sell the market. Let's say you want to trade the H4 chart. You have to look at the weekly chart first, then the daily chart. If the weekly and the daily chart analysis align with the H4 chart, you can then take your trading decision. If you want to trade H1 chart, you have to look at the daily charts first. This is a critical step to do as a price action trader because this will help you avoid low probability trading setups and it will allow you to stay focused on high probability price action signals.
Through our top-down analysis, we always start with bigger time frame and we look forward to gather the following information. Number 1, the most important support and resistance level. These areas represent turning points in the market. If you can identify them on the weekly chart, you will know what's going to happen when the price approaches this level on the H4 chart. So you will decide to buy or to sell or to ignore the signal you get from the chart. Number 2,
the market structure. The weekly analysis will help you identify if the market is trending up or down, or it is ranging, or choppy market. The market structure. The weekly analysis will help you identify if the market is trending up or down, or it is ranging, or choppy market. In general, you will know what the big investors are doing and you will try to find a way to follow them on the smaller time frame using my price action strategies. The previous candle. The last candle on the weekly chart is important because it tells us what happens during a week and it provides us with valuable information about the future market move. When you identify these points using the weekly chart, you can now move to the daily chart or the 4 hours chart and try to gather information such as the market condition. What the market is doing on the H4 time frame. Is it trending up or down? Is it ranging? Is it a choppy market? What are the most important key levels on the H4 or the daily time frame? These could be support and resistance, supply and demand areas, trend lines. Price action signal. A candlestick pattern that will provide you with a signal to buy or short the market. This could be a pin bar or an engulfing bar or an inside bar. Let me give you an example to help you understand why it is important to adopt the top-down analysis concept in your trading method and what is going to happen if you don't look at the bigger time frame before switching to your primary chart. Look at the illustration below. As you can see, in this weekly chart above, we've gathered 2 important points that will help us decide what to do on the daily time frame. The first point is that the market approaches to an important weekly resistance level that will represent a hot point in the market. The second information is the rejection from this key resistance level. As you can see, the price was rejected immediately when it approaches this level. This indicates that there are sellers there and they are willing to short the market. What confirms our analysis in the formation of the inside bar force breakout pattern that indicates a reversal. Now let's switch to daily time frame to see what's going on in the market. On the daily chart, we have a clear pin bar candlestick pattern that indicates a bullish signal. If you focus just on one time frame to make your trading decision, you will buy the market because there is a clear pin bar signal. But if you analyze the weekly chart, you will know that there is a very powerful key level that will stop the market from going up. So it's better to think of selling the market if there is a clear signal rather than to buy it. Look at what happens next. As you can see, a top-down analysis works. The pin bar candlestick signal doesn't work because the weekly resistance level was a powerful turning point that reversed the market's direction. If you want to trade price action based on one time frame, I highly recommend you to stop trading because you will end up losing your entire trading account and you will never become a successful trader. Trading counter trend is very profitable as well, but without the top-down analysis, you will put yourself in troubles. Let me give you another example to show you how you can trade counter trends using your price action trading setups in combination with the top-down analysis concept. As you can see in this chart above, prices are at a weekly resistance level. Buyers were rejected twice from this level, which indicates that the market is at a hot point and is likely to reverse. What you can do as a price action trader is to switch to the daily time frame to look for a selling opportunity. If you can find a price action setup near the weekly resistance level on the daily time frame, this is going to be a high probability setup to take into consideration. See the example below. The daily chart above confirms our weekly analysis. As you can see, there is a clear bearish signal near the weekly resistance level. The pin bar was rejected from that level, and there is also the formation of an inside bar force breakout. This is a clear indication of a trend change.
See what happens next.
The example above shows that counter trend works if it is well mastered. It's a contrarian approach that requires experience. So, if you are a beginner, I highly recommend you to stick with the trend. Try to practice as much as you can the top-down analysis concept with the trend, and when you master trading with the trend, you can then move to trade high probability counter trend setups. There are many approaches used to time the market turns and plan trades. The most of these approaches lead to greater confusion and lack of confidence in the result. Keeping the analysis simple is most often the best way to go, and top-down analysis is one of the easiest approach that I recommend to master if you want to trade the right way. What you have to do right now is to open your chart and try to practice what you have learned in this chapter.
Look at the summary in the screen and check if you can answer some of the questions. You see there, examine yourself if you've learned the things you see there. And also, don't forget to like, subscribe, and follow our channel. Thank you.